The world is witnessing the setup for what is likely the largest and most dangerous initial public offering in human history. Elon Musk is preparing to take SpaceX public at a staggering $1.75 trillion valuation. To put that number into perspective, this single company would be worth more than the entire American defense industrial base combined. It would be worth more than the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks all mashed together. It would even surpass the combined value of the top 10 companies on the London Stock Exchange. So you have to ask yourself the most uncomfortable question in finance today: who is actually buying this company? A business that is currently losing $5 billion every single year. The answer is uncomfortable, but it is true. The answer is you. Within a few weeks of this listing, your retirement account is going to be one of the largest buyers of SpaceX stock, whether you want it to be or not. And the only reason this is possible is because the Nasdaq quietly introduced a brand new, highly specific rule designed to force this exact outcome before we pull the thread on how they rigged the system. We need to understand the fundamental lie being sold to the public. A $1.75 trillion valuation only makes sense if SpaceX is the mythical company that everyone believes it to be. But it is not. If you walk down the street and ask 10 random people what SpaceX sells, most will tell you it is a rocket company, others will say it is about Mars. But both groups are wrong. SpaceX is not just a rocket company, it is a Frankenstein-like stack of three entirely different businesses, and the rocket business is arguably the least important one. There is the good, the bad, and the ugly. And trust me, it gets quite ugly. Let us look at the ugly side first because it creates the least value while burning the most cash. I am talking about xAI, which is mostly known for owning the social media platform X and the AI lab Elon founded in 2023 to compete with industry giants like OpenAI and Anthropic a few months ago. SpaceX acquired xAI in a massive all-stock deal that valued the combined entity at $1.25 trillion, with xAI alone accounting for $250 billion. If you are wondering how it is legally or ethically permissible for one company controlled by Elon to acquire another company controlled by Elon, the answer is that the rules seem not to apply here. With a $250 billion valuation, you would assume xAI is a financial juggernaut, or at the very least a stable operation. But none of those things are true. xAI was launched with 11 co-founders, a heavyweight team of engineers and researchers poached from DeepMind, Google, OpenAI, and the University of Toronto. But by 2025, the company was burning more than $1 billion every single month. By March of this year, every single one of those 11 founding members had walked out the door. Elon himself publicly admitted on his platform that xAI had to be rebuilt from the foundations up, which is just a polite way of saying that the CEO of SpaceX just paid $250 billion for an asset that needs to be scrapped and started over. To say xAI is overvalued is the understatement of the century. Compare this to OpenAI, which generates roughly $24 billion in annual revenue and is valued at $850 billion, or Anthropic, which generates $30 billion and is valued at $400 billion. But xAI, which barely scrapes together $1 billion in revenue, was bought for $250 billion. The market is pricing xAI as if it were a legacy powerhouse like Emirates. But the reality is more like a bankrupt budget airline. Think of xAI as the reverse Jerome Powell piece of SpaceX. Instead of printing cash, it incinerates whatever capital the rest of the business manages to generate. But xAI is only one of the three businesses. The other two are the ones doing the heavy lifting. Let us look at the rocket business, the part that gives the company its name. This is what people imagine when they hear SpaceX. It launches satellites for the US government, cargo for NASA, and crewed missions to the space station. Last year, the rocket business generated about $4 billion in revenue, which sounds impressive until you compare it to a $2 trillion valuation. Then it suddenly looks like a rounding error, especially when you realize the rockets only accounted for about 25% of the company's total revenue. That brings us to the third business, the one that nobody thinks about, but the one that keeps the lights on. This is the crown jewel, Starlink. It is essentially a satellite internet provider. The answer to the question of what happens if you take a legacy ISP like Comcast and throw it into orbit. It sounds like a ridiculous venture capital pitch, but Elon actually built it. Starlink launched in beta in 2020, and 6 years later, it is the fastest scaling telecom company in history. There are over 10,000 Starlink satellites in orbit, beaming internet to small dishes on roofs all over the world. Entrepreneur Scott Galloway called it one of the best tech products in years, and he is not wrong. Two things can be true at once. It is a game-changing product, and it is massively overvalued. Starlink has over 10 million active subscribers in 150 countries in 2025. It brought in $11.4 billion in revenue, which is roughly 61% of SpaceX's entire top line, but the growth is even more impressive. 2 years ago, profit margins were at 41%. Today, they are at 63%. That is 20 points of margin expansion in just 24 months. It is not just good, it is accelerating. Starlink is everywhere. It is in maritime, it is in aviation, and it has a classified defense arm called Starshield with massive government contracts. So this is the real SpaceX, a cash-printing internet provider, a decent rocket business valued like it has already colonized Mars, and an AI lab that lights $1 billion a month on fire, consolidated. SpaceX lost nearly $5 billion last year on $18.5 billion in revenue. So why is the market ignoring the loss and chasing the valuation? This is where the real story of the SpaceX IPO lies. It is not about space. It is about the financial system rigging the game on May 1st. The Nasdaq adopted something called the fast entry rule. And with SpaceX reportedly targeting a June listing, the timing is beyond suspicious. The Nasdaq 100 is the gold standard for growth, with over 200 investment products and $600 billion in assets. Tracking the index being included is a golden ticket. Under the old rules, a company had to wait 3 months before it could join the index. That waiting period allowed for price discovery, ensuring the market had time to value the company fairly before passive index funds were forced to buy. The new rule cuts that period to just 15 trading days. It is 3 months of price discovery compressed into 3 weeks, specifically to force passive demand. But that is not even the most important change. There used to be a minimum free float requirement of 10%, meaning at least 10% of shares had to be available for the public. SpaceX is targeting a float of only 4 to 5%. Under the old rules, they would be disqualified, but the new rules remove that requirement entirely, and then there is the hidden multiplier. This is the part that should terrify every retail investor for companies with a free float under 20%. The Nasdaq now treats the float as 3 times larger than it actually is. This means a 4% float is weighted as if it were 12%. They have effectively bent reality to roll out the red carpet for SpaceX. They changed the listing requirements so a company with only 5% public availability can join the index. They compress the price discovery timeline, and they force ETFs to treat the stock as if there is 3 times more supply than exists. This is manufactured demand, clear and simple, and it is not just for SpaceX. OpenAI and Anthropic are reportedly eyeing similar listings, and the rules are tailored perfectly for them. The Nasdaq didn't rewrite the rules for one company. They rewrote them for a class of companies, and SpaceX is just the first in line. Now consider the retail allocation. While most IPOs give 5 to 10% to retail, SpaceX is targeting 30%. The CFO explicitly said this was to reward retail loyalty to Elon in plain English. They are planning to dump 30% of the supply onto retail investors, not for stability, but because the retail base is loyal enough to absorb the shares at peak valuation. As portfolio manager George Noble put it, your 401k is the exit liquidity. If you have any sort of retirement account holding us index funds, you are going to own SpaceX stock in a few weeks. You won. T get a vote. You won. T get a choice. The passive machine will just buy it for you. The reality is that SpaceX is a mashup of 3 businesses that lost $5 billion last year. But because of manufactured demand, every passive investor is being forced into the position of a buyer. Passive investing was sold to you as the smart, low-fee, diversified path to wealth, and for the most part it is, but nobody mentioned that the very mechanism that makes your investing easy also makes you a guaranteed buyer for whatever junk the index decides to add next. This is why you must maintain discipline. Consistency without awareness is just blind compliance. When structural shifts occur in major indices, your passive strategy is no longer neutral. It becomes a vehicle for private entities to secure liquidity at your expense. Real financial freedom is built on understanding the plumbing of the system, not just setting and forgetting your investments. Keep your fees low, keep your eyes open, and never stop looking under the hood of your funds. Because the market is changing fast, and staying informed is the only way to ensure your capital is working for your future. Not serving as an exit strategy for the elite. Let us stay sharp and continue building real wealth the right way.